This walks you through the effects of transactions associated with the balance sheet. This is the balance sheet for the end of 2015. We are going to look at transactions and determine their effects on the ending balances in the ending 2016 balance sheet. You may want to print this out and try the changes yourself for this exercise. Based on this information, we need to adjust the ending balance for cash by $70,200, accounts receivable for $42,000, and accounts payable by $40,000, and enter it on the balance sheet for 2016. This means that we do not need to consider the effects on cash, accounts receivable, or accounts payable for any of the following transactions because that side of the entry is already reflected in the ending balances provided for this exercise. We now take the information provided and adjust the ending balances for cash, again for $70,200, accounts receivable to $42,000, and accounts payable to $40,000, and as we build the new 2016 balance sheet. We are now ready to analyze the effects of the following adjustments. Aero Company sold all of their investments at a loss of $5,000. We are only looking at the balance sheet, so all we care about is that the investment account was liquidated. The $5,000 loss is not relevant because it would be reflected in net income on the income statement. This transaction would reduce the investment account to zero. We revise the investment account to reflect the new balance of zero. Two tracts of land were purchased, one for cash of $38,000 and the other with bonds of $30,000. This transaction would affect two balance sheet accounts, land and bonds payable. Although the first tract of land was for cash, that part of the transaction would already be incorporated into the ending cash balance. The effect on the land account is to increase the account by $68,000 for a new balance of $108,000. Bonds payable would increase by $30,000 for a new balance of $71,000. We replace the balances in the land accounts and bonds payable account with our new balances of $108,000 and $71,000. Because the stock is issued at par, all of the proceeds are booked to common stock and increase the total to $130,000. If this stock had been sold an amount above par, then a new account would appear, additional paid-in capital in excess of par. This would follow common stock on the balance sheet. We then replace the amount for common stock with a new amount of $130,000. Based on this information, two accounts must be adjusted. First, the net plant assets must be reduced by $12,000 because the offset of the entry for the depreciation expense is accumulated depreciation, which is part of the balance sheet. Additional accumulated depreciation always decreases net plant assets because it is a contra asset account. The other account affected is retained earnings, which goes up with net income, then is decreased by the dividends. We replace the plant assets and retained earnings, which now include net income less dividends for 2016. We now add up the totals, and since total assets equal the total liabilities and equity, we are in balance for the 2016 year end.